Hey everybody, welcome back to Investing with Wesley. In my previous episode, there was a portion of it that got corrupted and I couldn't really give you the example I wanted to give you. So in this episode, I want to make up for that by giving you an in-depth example on how to analyze companies to determine whether or not they're worth your time investing in. So with that being said, let's jump into it. Now the first company we're going to analyze is Apple. And the reason I chose Apple is because it's an extremely large, well-established company, and it'll be really easy to gather some data on, so it'll make this example and showing you a lot easier. Now you want to start all fundamental analysis by pulling up the most recent 10K filing. In order to find this 10K filing, it's as simple as going onto the Apple website, scrolling all the way down till you see something called Investors or Investor Relations, something like that. You're going to click on that, and then you'll see different press releases and different filings. Now, there'll be quarterly filings, there'll be just financial filings, but you want to look for something called the 10K, and you want to look for their most up-to-date version of it. Okay, once you found their 10K, a PDF should upload and it should look something like this. Now, what I do, because I don't need to look at everything that this 10K has to offer, what I do is go to the table of contents, and the first thing I look at is the selected financial statements. Right here you see it under Part 2, Section 6. It's called Selected Financial Data. So we click on that and it takes you directly there. Now the first thing I want you to look at on this page is its earnings. Does this company's earnings have upward trends, meaning every year is their earnings growing? Do they make more money year on year? So what I'm looking at here is their earnings per share, their total sales, and their net income. If all of those are upward trending, that's a really good sign. So here in 2016 for their net sales, it shows 215,000. And then it goes to 229,000, 265, 260, and then up to 274,000. So you can see it's still upward trending, but just barely. It's almost level. And if you look at their net income, it kind of tells the exact same story. It starts off at 45,000, goes up to almost 50,000, then almost 60, back down to 55, and then again at 57, almost 60,000. So you see it back in 2016 relatively low compared to what it is now. So although it is upward trending, it's not extremely steep. It's not growing rapidly. And this is honestly to be expected from an established company like this. They already have their fan base. They already have the audience that they sell to. There's really no expectation to grow their audience or grow their sales rapidly. But just seeing the fact that they are still growing, even though they're already very well established, is an extremely good sign. Okay, so the next thing we're going to look at on their 10K report is we're going to try and calculate their debt to equity ratio. Now, I said in my last video that for more conservative investors, you want to look for a debt to equity ratio of about 0.30 or less. But like I said, that is for conservative investors. The broad market average for debt to equity ratios is 2.0. So if we can get as close to 2.0 or even under as we can with Apple, then we know they have a really good debt to equity ratio. So in order to find this ratio, you have to divide the total liabilities by the total shareholder equity, and that gives you the debt to equity ratio. Now, honestly, with very large, well-known companies like Apple, you could actually type in what is Apple's debt to equity ratio, and it'll give you the most up-to-date ratio. But I'm still going to show you where to find it in their 10K. That way, if you're looking at a company that's not as well known as Apple, or if you just want to learn how to do it yourself, you'll be able to do that. So scroll down from their 10K about 10 pages or so, and you'll get to their balance sheets, or a summary of their balance sheets. In here, you'll find some sort of title or headline called Liabilities and Shareholder Equity. It's in this section you want to search for all the information you're going to need to calculate their debt to equity ratio. Now, for most people, what they'll do is only calculate their current liabilities and leave their non-current liabilities out of the calculation. What I want to teach you how to do is see both of them. What I want to teach you how to do is to calculate their debt to equity ratio on their current and non-current liabilities. So on their 10K, their total current liabilities are $105,392, while their total shareholder equity is $65,339. So if you do the math and you just open up a calculator and divide the larger number by the smaller number, you'll get their current liability debt to equity ratio, which, to save you from doing the math yourself, I already did it for you. The answer for this calculation is 1.6. So using their current liabilities as a calculation of their debt to equity ratio, they're actually under the broad market average, which is extremely good. But I don't want to just teach you to stop there and fall for that trap, because they may have accumulated a large amount of debt that's just not current yet. So I want to also teach you how to run the numbers on their total, the current and non-current. So if you take their total liabilities of current and non-current, that number is $258,549. Divide that number by their total shareholder equity of $65,339, and you get a debt to equity ratio of 3.9, almost 4, almost double the broad market average. Now, even though their total liability debt to equity ratio is double what the broad market average is, having a debt to equity ratio of 4.0 is still pretty good, considering I've seen some companies that are in the double digits, even triple digits when it comes to their debt to equity. Although most of the stuff when you're doing your comparisons, you have to also compare it to that industry's competitors. So I can't compare Apple to some construction company because the industries are totally different. You have to compare apples to apples and oranges to oranges in order to know whether this particular company you're thinking of investing in is worth your time, or if you should go and invest in one of their competitors. Okay, so we're almost done analyzing everything we need to know on their 10K when it comes to their financials. The next thing we want to analyze is their PE ratio, or their price to earnings ratio. Now, with the majority of stocks, again, you could just Google what is the PE ratio of Apple stock, and it'll be able to tell you right then and there. But I want to teach you how to do it yourself, because that information may not always be accurate or up to date. So in order to find the PE ratio, you divide the company's share price by its earnings per share. So from that last page that we were looking at on Apple's 10K, if you scroll back up about 2 pages, you're going to get to this page. And this page, you're going to see something called earnings per share. And just for me personally, I always take just the basic earnings, not the diluted earnings. The basic earnings for their earnings per share is $3.31 per share. So now we have to figure out what their current share price is. This is as simple as just going on Google or any search engine and typing in Apple company's ticker symbol, which is AAPL, and it tells me that their current share price is $131.79. So we take $131.79 and divide that by their earnings per share, which we saw was $3.31. Now that gives a PE ratio of almost 40. Now, like I told you in my previous episode, the average PE ratio is about 15 across the broad market, but obviously things are industry specific, so you should look at other people's competitors. The price to earnings ratio basically tells you what people are willing to pay for $1 worth of their earnings. So in this example, people are willing to pay $40 right now to get $1 worth of their earning, expecting them to go up in value and expecting them to earn more over time to make up that initial loss. This is one of those extremely important things that you have to factor into your decision on whether or not to invest, because if their PE ratio is 40 like Apple's is right now, but their actual income or what they earn is not going up as quickly as you might want it to, it could really affect whether or not you're going to invest in that company. As an example, if their earnings were not going up whatsoever and just staying completely flat, then I'm not going to want to pay $40 in exchange for $1 when I'm expecting their earnings not to grow at all. But if their earnings are growing and growing year after year, then it may be worth taking a little bit of an initial loss right now in order to lock in and capture all that upside growth that they'll see year over year. Okay, so the next thing you want to figure out is, how does this company treat their dividends? Are their dividends going up? Do they pay a dividend at all? Are their dividends going down? Are they in some sort of financial trouble? You really want to look at what they're doing with their dividends. In the case of Apple stocks, you can find it on their 10K, just 1 or 2 pages below the previous page. You're going to see something called dividends and dividend equivalents declared per share. And in this case, you'll see that in 2018, it was 68 cents per share, while in 2019, it was 75 cents, and then currently it is almost 80 cents per share. So you actually see that their dividends are slowly increasing over time, meaning you're getting a little bit more money every time they send out a dividend. It's also a good sign that their equity or that their earnings are growing over time, so they can afford to give out a little bit more of their earnings to their shareholders. Now, and remember, in my previous episode, I also said that some other things to factor in were, is this company's technology or service going to be needed in the future, or are they going to be replaced with newer technology, basically? Now, when it comes to Apple, they're extremely innovative, so that's not really a worry. But another thing you also want to look at that a 10K won't usually show you is the company's leadership. Search up their reputation, search up how long they've been in the industry, how long they've been in these leadership positions, and figure out if they're really good leaders or if there's some liability. I mentioned in my previous episode that I decided to invest in Royal Caribbean when all the travel industry was tanking last year, strictly because the Royal Caribbean CFO has an extremely good reputation with being able to handle this company's finances, as well as they were able to secure a $2 billion line of credit to float their liabilities on. Now, a 10K won't really show you those things, but there's one other thing that you really want to pay attention to when you're deciding whether or not to invest in a particular company, and that is a company's PEG ratio. Now, this stands for the price to earnings growth ratio. Now, unfortunately, it's all estimated, so a 10K filing won't really show you because 10Ks are current numbers, whereas estimations are guesses on what their future earnings will look like. So for the most part, with extremely well-known companies, again, you could search online, what is Apple stock's PEG ratio, and it'll be able to tell you. Now, the PEG ratio will give you the company's value while factoring in the expected or estimated growth of their revenue over a set period of time. In order to find the PEG ratio, you want to divide their PE ratio that we just got done calculating by their estimated growth in a particular time. So really, what does the PEG ratio tell you? Well, the PEG ratio will tell you if a stock price currently is undervalued considering what its future earnings could look like. So even though it's estimated, if you could find a way to get as accurate as possible of a PEG ratio for a particular company, you'll be able to tell whether or not their current share price is undervalued considering their future growth. The closer the PEG ratio is to 0, the more undervalued a company is. Now, these numbers are always going to be very small. The average PEG ratio, or what would be fair price, is 1.0, whereas anything over 1.0 PEG ratio is considered overvalued. So if we Google what is Apple stock's 1-year PEG ratio, that means we're basically going to guess what their earnings will be next year and calculate that against their current PE ratio to figure out if the current share price is either over or undervalued. And if you do all of that math just to save you the trouble, their current PEG ratio for 1 year's time into the future is 2.01. So more than double what the estimated fair price is set at. So you know right now, based on their estimated growth of earnings compared to what their current share price is, they're actually considered overvalued. Now again, that was only for 1 year into the future. If we calculate it on 5 years into the future, will this number be any different? Well, if we Google Apple's earnings growth rate over the next 5 years, it's going to give you a percentage of about 17.93%. If we just round that up to 18 and put it into this calculation, dividing 40 into 18, we'll see a PEG ratio of 2.22. So whether it's 1 year or 5 years into the future, they seem to be hovering at about double what fair price is. Meaning if you're going to jump into Apple stock and invest it, you better be in it for the long haul and have no intentions to sell within the first 5 years. Otherwise, you'll be paying a premium and not really collecting on that money and collecting enough profit to make buying at an overvalued price worth it. Now, I had plans to review 2 other companies. I wanted to review Altura Group as well as Royal Caribbean, but this video has already become extremely long as is. So if you guys want me to review their 10Ks and make videos reviewing other companies, feel free to like, subscribe, and leave a comment telling me to do so down below in the feed. I have a dedicated Facebook and Instagram account, so if you ever had any questions or comments or just wanted something addressed, feel free to reach out to me there as well. I don't post there too often, but I'm on there pretty much every day just randomly scrolling. And it'd be a lot easier to keep track of everyone's direct messages than replying to everyone down here in the feed. Either way though, the choice is yours, and I'll see you in the next episode.